All right, let's give you that markets update now. The JSE expected to follow global market trends as Asia and the United States saw overnight gains. Tech giant Tencent also traded higher, and benefits from that are expected. Now, the investors, though, are still looking at the expected U.S. inflation numbers. Independent markets analyst Jimmy Moyaha joining us now for a quick check of how things are developing at the JSE. Jimmy, good morning to you and Happy New Year, might I add. What has transpired so far in today's trade following that global market performance, which is due to hawkish U.S. Fed?
Good morning and a Happy New Year to our viewers. The markets have had a softer than expected open. We've seen that the top 40, whilst we're expecting to still see gains off the back of that 10-cent gain, as you rightly mentioned. We're expecting to see the market trade up close to about 1%. At the moment, we're seeing a bit of a flat open. There are obviously still concerns around how much further we're going to see the top 40 rally, for as an example. I mean, we know that we're at all-time highs at the moment, and we've sort of eclipsed the highs that we've seen in the last couple of years as well. So it's definitely a precarious position to be in amid the ongoing sentiment from around the world. We know that we're hearing hawkish tones out of the US, but we're also hearing concerning conversations coming out of institutions like the World Bank, which is a continuation of what we saw last year with global GDP and outlook forecasts being revised down consistently, and increased inflationary pressures being raised as concerns. So at the moment, the market trading slightly positively, but largely flat as compared to where we've seen it in the week. We've seen it over top 40 as high as 72,000 points. So we're back just below, just under 72,000 points at the moment. But we will likely see that as developments come out from the US as well as China. We've got China data, China CPI data coming out tomorrow ahead of the US's CPI data. So it'll be interesting to see how that data impacts emerging markets and just markets in general.
Yeah. Let's talk for a moment about the World Bank, which has again raised concerns over the risks of a global recession. Now, my question is twofold, Jimmy. Is this a possibility or perhaps a foregone conclusion in the year 2023?
I think at this stage, it's a growing possibility. It's a possibility that central banks and other decision makers around the world have tried to do their very best to avoid this. But what we've seen out of countries like the US that have been sort of at the forefront of these inflationary conversations and the interest rate conversations from a central bank perspective is that we've seen conflicting reports coming out of there. We saw towards the end of last year that there was a bit of a dovish tone around the possibility of rate hikes, and we've seen that from the Fed Chair, Jerome Powell, saying that they might slow down and they might taper the rate hiking cycle and sort of slow down in the aggressiveness of that. But now we've seen from other central bank members within the Fed to say that they're expecting rates to peak above the 5% mark, where previously we were looking at between 4.2 to 4.5%. We're now looking above the 5% mark, which is a very hawkish stance from that perspective. And so what we've seen overall is that central banks and decision makers, where they've tried to mitigate whatever they can, there have been certain factors that have been out of their control, the leading factor of which has been the inflationary factor, and that's caused them to take a more accommodative approach to say, we're going to tackle the inflationary conversation and we'll put the recessionary worries and the recessionary impacts of those inflationary conversations on the back foot until we can sort of see where we're looking at from an inflationary picture. So I think there's still a very real possibility that we are looking at, or we're facing the possibility of a global recession and a US-led recession. And we have seen concerns around regions like the UK and Europe also saying that they're expecting that we are heading towards a recessionary type of environment. But the World Bank's basically come out to say that the persistently high inflation, as I mentioned, the Russia-Ukraine war, the decline in investment overall off the back of concerned sentiment is what's going to be driving global growth forecasts lower, and that could potentially trigger the recession. We know that from these reports that the leading driver of global economic growth for this year is set to be China. And if that doesn't come through with China, they have said they're relaxing some restrictions, but if they don't go the route of relaxing, or if they continue to see problems on the COVID side of things and they have to make adjustments, we could see that could be another catalyst that could trigger a global recession at this stage.
Yeah. Then today, there's the launch of the World Economic Forum Global Risk Report. Now, this comes at a time of the Russia-Ukraine energy supply challenges, and add to that what we have just discussed, the looming recession. How extensive do you think this report is going to be?
Well, I think at this point, from all information houses and research houses, the research and the information that comes out is going to be imperative towards assisting decision makers in making what they feel is the best decision at that time. I mean, if you look at the report that's coming out, the top 10 risks that are sort of highlighted range from climate change to macroeconomic factors to financial stability risks and those sorts of things. So I think at this stage, of the 58 countries that were looked at and surveyed, there was quite a bit of research done to try and determine whether or what the factors are going to be or what the risks are going to be at a global level. But I also think that some of the countries, emerging countries like South Africa, for example, might be facing additional risks on top of what has been outlined. So we'll see that at a global level, at a macro level, that reports like these are going to be used by decision makers in terms of driving policy, driving sort of where they see the outlook and where they see pressures coming from their environments. But each central bank will likely still then, or each decision-making body, whether it's a central bank or a government, in that case, will likely then look a little deeper and say, from this perspective, what localized risks are we looking at that might compound the global macro risks that are out of our control? So they might want to focus on mitigating the local risks that they're seeing, and using this sort of data and these sorts of reports as a plenary for identifying how they're going to manage the greater risks in line with what we're expecting at a macro level.
Yeah, let's get into company news, starting in the UK, where jobs are on the line at Amazon, as the company says it wants to restructure its warehouse operations. Question is, what's behind this move by the US online retail giant?
So Amazon has said that they're looking to close down 3 of their centers, and that will affect about 1,200 jobs. But they've said that they're happy for their staff to relocate to other locations. They've also said that of their other sites, they're looking to have 2 new warehouses online by 2026, which will create about 2,500 jobs. Amazon said that they're evaluating their businesses or the network that they have, and trying to ensure that they offer best customer experience and best user experience for their employees as well as their clients. But if you remember, I mean, Amazon mentioned something critically, is that during the pandemic, tech companies like Amazon were hiring quite rapidly at that time. And I think at this stage, it's not just Amazon that's going to be restructuring at this point. We've seen that they've committed to, or they announced that they're looking at job cuts of about 18,000 jobs worldwide. But this is not the only company that's doing this. This is not the only Fortune 500 company that we're seeing follow this sort of trend and conversation. Salesforce is another example that said that they're cutting about 10,000 jobs as well on their side. So I think at the moment, the uncertainty, and that's the reason that Amazon has cited, is that economic uncertainty is the biggest factor that they're looking at this stage. And that ties in with what we're seeing around the world. That ties in with the conversations that we've been having around whether or not we're going to see more rate hikes from the US, whether or not we're going to see the expected economic growth from China, whether or not we're going to see a global recession. And companies the size of Amazon that employ about 1.5 million people globally have to look at these sorts of factors when they have such a large workforce. And for them, that's a natural thing to do, is where economic conditions are tight, where profitability conditions are going to be tight, they're going to be looking to adjust costing where they can. And unfortunately, the workforce, as large as it is probably where they would start in terms of reducing costs and reducing headcounts. We've also seen that going into, or sort of ending the year last year, we saw companies take a back foot of global forecasts and forecasts into 2023 amid the uncertainty. So there's been a lot of tapered forecasting around where revenue numbers are going to sit, where earnings numbers are going to sit going into the new year, and it's been sort of a wait-and-see approach. And Amazon's just taking risk and then cost-cutting measures ahead of the uncertainty just to mitigate that from their perspective as a business.
Yeah. Finally, and very briefly, if you can, Jimmy, a 91 managed fund has committed 450 million rand toward a hydropower plant in the Ivory Coast. This, of course, will be viewed as a positive in the alternative energy solutions agenda. How do you think the market is going to digest this?
Well, I think at the moment there has been a big drive towards ESG initiatives, renewable energy initiatives, along with the climate crisis and the climate goals that we've set out for the world. So I think companies like 91 are going to definitely see a benefit from this. We have seen that there's an expectation that big asset managers, big hedge funds, and those sorts of companies are going to struggle going into 2023, 2024 rather, from a returns perspective and from a portfolio perspective. And I think these sorts of investments are not looked at from a short-term point of view. I mean, the point of view that 91 is looking at this from is probably going to be to say, whilst we're having economic conditions that are in this light, it's probably good to invest where we can invest and not have idle cash if there is idle cash, but also if the funds are able to then start to build now by the time economic conditions start to turn around, those sorts of funds and infrastructure developments are in place, and regions like the Ivory Coast will see the benefit of that in the long term. I think from a South African perspective, we can certainly take some positives from that and look at what our own energy conversations might start to look like in this time if we've seen companies investing along these sorts of lines. If that investment is going to be continuing, should we not be looking at that from a South African perspective to say, amid stage 6, how do we then deal with the conversations around renewable energies? Is this the right time? Or are we going to wait to deal with that at a later date? But from a 91 perspective, that's certainly going to be a positive for their share price. It's already sitting just below the 40 Rand level. It's bounced off a key 35 Rand level sort of towards the start of the year and towards the end of last year. So at the moment, we are sitting just below 40 Rand, and we should possibly see a lot of positivity coming from this announcement.
Jimmy Moyaha, thank you very much for that market update.